I'm now joined by Andrew Popper. He's Chief Investment Officer at SG Private Bank. Andrew, thank you so much for coming in.
Good morning, Francine.
We were just actually talking about the significance of this. It really cements China's powerhouse status. Does it actually mean that investors will now be less wary of investing in the country? Are we going to have an emergence bubble coming at the forefront again?
Well, I think that without a doubt it's a landmark today to see China becoming the second largest economy in the world. It's not very surprising, and it was predictable considering the economic trends. Whether the investors will be more confident, I think the mere fact that China surpassed Japan as the second largest economy is not meaningful from that point of view. I think in order for the investors to be more confident in China, they will have to see more stability in the legal framework. They will have to see more protection of intellectual rights and other type of rights. So I think that's more important from the point of view of the investors rather than the size of the economy. But of course, it is an important moment, and without a doubt, China is becoming now or it has become a force to be reckoned with, without a doubt.
And it also has the biggest foreign exchange reserves. Now, we're hearing today that they're, for example, turning bullish on Europe and Japan at the expense of the US. Are you looking to see what they're doing to also position yourself? Do you believe that Europe is now in a stronger place than the US will be in the next couple of years?
No, I don't think so. I think that what the Chinese are doing from the point of view of the reserves is exactly why they said, to diversify. They're already heavily concentrated in dollars, and it makes sense for them to diversify their currency reserves. I don't think that even in China's view, Europe is taking a place ahead of the US from the point of view of economic prospects, from the point of view even of the currency strength. Sure, we have a moment of relative strength of the euro. We saw some good figures that emerged from Europe in terms of European growth, but even those figures, they indicated a lot of divergence in Europe. So I'm not particularly optimistic over the long term for the prospects of the euro. The problems that we experienced in May and June, they are still in place. So I think the Chinese see that as well, but they just simply want to diversify.
But Andrew, how worried are you actually about what we've heard from the Fed, that they're willing to pump in more money? This is the first measure that we've heard in the last year where it's again putting extra liquidity on the market.
Well, what they're doing actually is to maintain the same size of the balance sheet. There's a lot of assets which the Fed had purchased, which are now rolling off. They're coming to maturity. So if the Fed allows those assets to come to maturity, that would imply a reduction in the size of the balance sheet, a reduction of the reserves of the central bank. So all they are doing is to replace with different type of assets, the assets that are coming off to maturity.
So given all of what we've talked about, in 20 seconds, give me your ideal portfolio. How much do you put in equities and where do you put them regionally?
Well, the ideal portfolio for us at this point depends on the level of risk that the clients want to take. But the ideal level of risk is underweight in equities, quite significantly underweight in equities, overweight in bonds, and perhaps in this case, hope against experience. We're also still overweight in hedge funds, hoping that they will be able to take advantage of the current dislocations in the market.
Andrew, thank you so much. Andrew Popper there, great to speak to you.